Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. We are seeing Brent crude oil consolidate its position well above $90 now, above $92 on Brent this morning. Even WTI is challenging to break through 90. The move that we saw last week during the APEC events in Singapore and the announcement by Saudi Arabia to extend its unilateral 1 million barrel a day cut through to the end of the year has really given the velocity that this market was looking for to sort of make that ascendant sort of challenge to $100 a barrel. Let's welcome this morning our three speakers. Kick off with Andrew Critchlow. Video is off. Is that what you're telling me? I'm getting messages that my video is off. Okay, well, let's see if my video is off. It is off. Why can't it go on there? It's on and now it's off. There it is. Jeez Christ. You couldn't do without this handsome face. Well, we'll go to one other more handsome, fitter face. Andrew Critchlow, Head of News, EMEA, S&P Global Commodity Insights. Andy, welcome back. I hope you had a good summer.
Yeah,
Is there anything that you can see that stops this momentum? We're now 30% up since the low in June, 30% over 3 months. Anything to stop this continuing and sort of going towards that $100? Your thoughts?
Yeah, it's really difficult to see anything kind of dampening the bullish sort of trend, which is not just pushing flat prices of crude at the moment, but it's also very much evident in products. One of the things that we're looking at very closely into this quarter is demand for diesel in Europe. Of course, this is going to be the first winter where you haven't had that flow of Russian diesel in significant volumes coming into Europe. And so there is already a bit of a scramble in the European market to get products. So last month, for example, shipments into Europe from the Middle East climbed to 420,000 barrels a day, according to S&P Global Commodities at Sea. And that's up from 353,000 barrels a day. So when you look at that and how it translates to price, the low sulfur gas oil ICE futures contract assessed by Platts, that's now trading at its highest since January. So, there's a couple of things behind that. One, there's refinery maintenance, which is now starting to kick in, but also it's just that lack of product that traditionally has come from Russia, and someone's got to fill the gap. So you've got this dynamic now where diesel, for example, is actually acting to pull up flat price of crude. And I think that dynamic is going to pick up, and you add that to everything we've seen now from OPEC restraining production, exports. You add that to, still this trend of there is a little bit of demand still coming out from post-COVID, more air travel, just more economic activity. Yes, question marks over China. Yes, question marks over growth and inflation. But actually, it's a rising tide lifting all ships at the moment. So, very bullish signals pushing towards that $100 a barrel sort of key marker, which a lot of the Middle East producers are looking for.
Ed Bell, Head of Market Economics at Emirates MBD. Of course, Ed, this is in the face of Fed rate hikes, 500 basis points over the last year, and across Europe and the British, the UK central bank as well, have all been trying to challenge the inflation. Is that cycle over? Could that still be the Fed in particular in the fourth quarter this year, going one more hike and then possibly putting a cap on this rally? Your thoughts?
Well, our view right now is that the Fed is done, that their last hike was, or the one that they had in July was the last hike they needed to do, and that they will hold rates now for an extended period until the end of the first half of next year. I think, we might see some ticks higher in the headline CPI from the US, which is actually due out later today. A lot of that might be driven by the kind of energy price inflation that we're seeing, as Andy's laid out about the moves we've seen in gasoline prices or product prices. I think the Fed is really going to try and look through those dynamics though, and really focus on sort of the core inflation pressures in the US. Those have been on a disinflationary trend. I think they want to see them entrenched a little bit more. but I don't think that they're going to say that they need to tighten policy even further, because it's already in quite a restrictive mode. And if they hold policy unchanged from where it's at now until midway through 2024, then policy rates in real terms are going to be at very restrictive levels, well above what the Fed classifies as sort of the neutral rate of interest. There could be a little bit more room, though, for the European Central Bank and the Bank of England to have to hike rates. We had jobs numbers out from the UK yesterday, which, depending how you're looking at it, could have been good, could have been bad. From the point of view of the Bank of England, you have wage growth of more than 8% year on year in the UK's, and that's passing through into higher services inflation.
Let me just challenge you a bit, Ed. I mean, how can you call a hold at this point when the target inflation rate is still double the sort of mandated objective of the Fed?
But it is going down. It is decelerating, right? So, and you have
the deceleration has stopped, if not slowed, at least. I mean, the idea that
deceleration that we've had in inflation so far, we've only just gotten into real positive rates. Going forward, if that deceleration in inflation continues, you're going to have a very restrictive environment, even if you don't need to move up anymore.
Which in itself then could be the cap on $100 oil, right? If you don't raise rates, it means the 500 basis points is working and the economy is slowing, and then you would expect prices not to continue rising. Could those two things coexist?
Yeah, I mean, I think the relationship between rates, the dollar, and commodities, they're very I think it's hard to put that into a tried and tested economic model and say that those things always work all the time. Sometimes they work in tandem. Sometimes you can have the opposite scenario which we're in right now. If you look at August or you look at the summer, you had the dollar soaring, you had oil prices soaring. That's not supposed to happen, right? They're supposed to go in the opposite direction. So you can certainly have both of those dynamics coinciding. And I think we could get into a period where, yes, you do see the impact of the tightening that has been taken so far feeding through onto consumers, onto businesses in the US. That starts to chew away at some of the marginal demand growth in the US for next year, more likely than the end of 23. And that perhaps puts a bit of a dampener on oil prices. Maybe not that they squash them, but it just makes it that much harder to go higher and higher.
Let's go to Mark Howson, head of Asia for Wellington Analytics. Mark, of course, LNG and gas demand in Asia, and particularly China, is a big bellwether to the economic health of the region and hence its energy demand appetite. China's Sinopec has just issued a tender seeking 25 cargoes of LNG over the next year. Is it all bumper go in China on gas demand? And so the economic health there, one should be bullish on?
Well, certainly, Sean, you mentioned APEC a minute ago. And of course, we also had the Gastech conference here in Singapore last week, where we actually got almost 50,000 attendees at that event, which obviously is a record and it's the biggest Gastech I've ever seen. And to answer your question, the mood in Asia here is very much bullish in terms of LNG demand, gas demand. You mentioned China in particular. Chinese economic growth is, some people are saying it's a bit disappointing, but it's still running at almost 6.5% GDP growth. And in addition to that, if you actually look at how much incremental LNG China has brought in the first half of this year, it was up 7% year on year. And that's obviously in addition to increasing their domestic production, but also their piped imports as well. And we can just see how fragile, particularly this Asia Pacific market is, because we're still only buying and procuring cargoes for November, which isn't obviously the peak winter demand season, but LNG prices here are already, spot prices already over $13 per MMBTU and over $11 per MMBTU in Europe, which is particularly high for this time of year. And we just saw when an event happens, or even the threat of an event, we obviously had strikes in Australia from the Chevron plants, Gorgon and Wheatstone, that started on Friday, but haven't really affected LNG production yet. However, prices do just jump up quite aggressively on the back of that news. So the market here is still pretty supply constrained and quite frankly pretty fragile going forward.
So not demand led, it's more supply constrained, a bit like oil.
Well, in the case of China, it is very much demand-led because their economy is growing, and quite frankly, they have quite serious emission reductions targets, which means the gas and LNG has to offset their use of coal. And likewise, across South Asia and Southeast Asia, if you look at their gas balances, all those countries are facing growing demand because the economy is developing, but they've got falling domestic production. So in terms of LNG, it is very much a growing market, and a growing market where there's very little new supply coming on stream at the moment. And in the case of Australia, potentially falling supply.
Andy, one might look at the potential to dampen the oil soar of the last 3 months surge, that stopped that surge to 100 could be non-OPEC supply, or even within OPEC plus those countries that are not confined by the agreement, i.e. Venezuela and Iran. Can we see either non-OPEC, the likes of Guyana, or OPEC plus countries non-confined? Could they bring supply that could sort of dampen down this tightness?
Well, we're already starting to see that in terms of Iran and more Iranian barrels, according to the S&P Global Commodity Insights survey, secondary survey of OPEC production, which we just published. Iran's output, surging. Its exports into the market have increased. It's looking at new and innovative ways to do that. Of course, the swap deal that was announced with China last month in terms of trading oil in return for construction services, etc., to build an airport. We could see more of that, and these methods have been used previously as ways for countries like Iran and Venezuela to bypass sanctions. It was something that was very much a feature of Iraq's oil trade during the oil for food program days. So yes, I think that's fair to assume. The monthly oil market report that OPEC just put out, it actually lowered its call on OPEC crude for the remainder of 2023 by about 70,000 barrels a day. So they're being quite kind of hawkish at the same time as they're saying, well, actually, we're going to cut production for countries that are bound by the quotas. I mean, what's clear here is that the main producers, Saudi Arabia and Russia, are driving for a higher oil price, although they may not actually state that publicly. I think it is interesting, however, the tension that it creates within the group that are bound by quotas. So countries like the United Arab Emirates, for example, where producers like ADNOC are investing heavily in boosting capacity up to and beyond 4.2 up to 5 million barrels a day. If you can't produce that oil, then that's a big sunk cost that is just stuck in the ground.
Ed, the big sort of question mark, of course, as we get into these elevated levels and move towards the triple digits, is $100 isn't what it used to be, right? I mean, you go out and try buy a can of Coke or a latte, and everything is elevated. And as Jorge, one of our speakers, said earlier in the week, you can't have elevated airplane ticket prices and banana prices and everything prices and not have elevated oil prices. Does this level create a problem for the OECD in particular? I'm thinking, obviously, for the emerging markets, it's expensive, but where does it meet the rubber meet the road on this? We're not hearing the usual voices of complaint when prices get this high. India are silent. The US, at least in public, are silent.
No, that's interesting. Yeah, that we haven't had the same kind of messaging around this fear of energy price inflation coming back into the market like we had really over the last couple of years, when you had this somewhat awkward geopolitical pressure trying to be placed on the OPEC countries to increase production. And so far, we didn't see any kind of commentary about energy price security at the G20, for instance, or that you would have reliability of supplies in the near term, at least. I think it could be that there's a couple of other relief valves that have been happening in the market. If you look at Europe, for example, inventories going into the heating season are in a vastly different picture than they were last year. So you're not having the same kind of volatility in electricity and heating price and gas prices in the EU. So maybe that's taking a little bit of the edge off of the sort of fear of energy price inflation. And it could also just be that consumers have become more inured to the fact that we are in a higher inflation environment, and so are adjusting their spending accordingly. Or rather than their spending, adjusting their savings as well. As you mentioned, you know, things like airline tickets are very expensive. Hospitality internationally is expensive. So if we're just getting accustomed to that, the cost of operating in this economy post-pandemic, then you can wear down on those savings. Hey, if you've been able to benefit from higher wages as well, you can withstand it a little bit better. But so far, it doesn't seem to be raising a political stink in many of the kind of capitals where you think it would have been.
We have a senior executive from KPC in our weekly interview that's going to be published after this podcast who says, you know, 90 to 95 is everybody is comfortable with. It's not as elevated a price as it was before. And of course, a year ago when we saw these prices previously, it was on the dawn of the US midterm elections, and we're maybe a bit too far away from the US presidential elections for this to be an issue at this time, but it could become so. Where does that sort of feed through into the thinking, do you think, of the regional countries, Ed, just to follow up on that, from the point of view of the sort of critical relationship with the US? It's a lot of talk that it's not what it used to be, and so this may not be something that is a top priority on this cycle.
Yeah, I think we've seen resistance from the core producers in the GCC to responding to, say, US political pressure that would help the domestic political situation in the US to increase production. I think there's also been maybe an overemphasis that the GCC is moving away solidly into China's hands, for example, away from the US. I don't know that that's a solid trajectory, that's going to go only in one way. I mean, you saw on the outcome of the G20, this EU-US supported deal that would provide more infrastructural links between India, UAE, Saudi, Jordan, and Israel. I mean, that's, to me, an assessment that there's still a lot of soft power interest from the United States toward this region, and it's being reciprocated and certainly welcomed. So I think the sort of trading relationships or the political relationships, perhaps they don't have the same kind of emphasis that they may have had a couple of years ago, but that doesn't mean that they're necessarily, you know, hostile or antagonistic in any kind of way. I think certainly from the United States point of view, Middle Eastern economies taking sort of more initiative to cool down tensions within the region is certainly going to be a welcome development, and I think the regional governments are accepting that as well.
Mark, I wanted to get your views just to drill down a little bit on our earlier point regarding the health of Japan and Korea. Of course, two of the biggest LNG markets in the world, and in Asia, they pull a lot of the Gulf LNG in that direction. But both of them are having difficult times, particularly Korea and other manufacturing centers in Asia, Vietnam. How is that translating into the LNG market? And I'd like your sort of midterm outlook as well for Qatar's increased capacity that's coming.
Yeah, absolutely, Sean. Just going back to one of your earlier points about why has this not created more of a kind of political big problem in the West? And to me, if you look at the LNG side in the US in particular, it's very interesting because 10 years ago, the US didn't export any LNG. And literally in the first half of this year, they've just become the world's largest LNG exporter, surpassing 80 million tons, surpassing both Australia and Qatar. So, of course, with these very high oil and gas prices, that huge segment of the US economy, which is the oil and gas business, actually benefit quite a lot, and also obviously geopolitically coming to the rescue of Europe in their time of gas need. Meanwhile, of course, domestic gas prices in the United States and also Canada, which by the way is also going to become an LNG exporter for the first time next year, have been very moderated and very much disconnected from these higher natural gas prices elsewhere. So maybe it's that disconnection that means there's been less of a political hot potato over there. In terms of Asia, Sean, you mentioned Vietnam, you mentioned Japan, you mentioned Korea. Japan was one of those countries where LNG demand did actually fall quite dramatically in the first half of this year, predominantly because of, like you say, economic weakness. But you mentioned Vietnam, and you mentioned also another country similar in a way, in a similar situation as Philippines. And both of those countries haven't been able to incentivize either their domestic production or any piped imports of gas from their neighbors. So they have been forced, despite the relatively high prices this year, to begin importing LNG this year already. And that happened for both countries over the summer. So even if the economies aren't growing particularly fast, just given the fact that they haven't been able to incentivize enough upstream investment into their countries, they're still having to come to the market to buy more LNG cargoes.
Let's go to this survey question and look at some of the sort of views on this question that we are discussing. Which of the following could stop Brent reaching $100 this year? More Fed rate hikes, China slows further, more non-OPEC supply, or for nothing can stop it. Your thoughts on where that goes. Andy, I wanted to get your views also. I mean, we talked there, the region, the sort of geopolitics of everything. We're seeing the continued but somewhat slow birth of a rapprochement with Iran, obviously the Saudi-Iran agreement earlier this year, but now the US seems to have come to some agreement on the hostage or the prisoner release, hostage release, whatever you want to call that, in trade for $6 billion. Moving back $6 billion of Iranian money that was being held in Korea. Your thoughts on this development and the regional geopolitics in the region of the Gulf leading to greater oil flows into the last quarter of the year?
Well, I mean, the Gulf states, I think over the last 10 years, the big change for me, if I think back to, when I was based in the region, 2000 through to 2010, it was very much you kind of locked into the, the kind of bipolar world of you align to the West, the US, implicit security guarantees, and that the US government and the Western partners would have a certain level of influence when it came to dampening oil prices, influencing, big regional players in terms of production policy, and that translated through to OPEC. That has now all changed fundamentally. We live in this very complex multipolar world where the region and the regional power players like Saudi Arabia, the UAE, etc., they're wanting to, and Qatar, are wanting to build these strong relationships, with different partners, whether it's Russia, China. It's not to say that they're wanting to completely sever the umbilical cord with the United States, that they want to turn their backs on that implicit security guarantee, which the US taxpayer is still willing to fund. But they are definitely building, stronger bridges to the east, and that ties into the flow of products. We just heard in terms of LNG flowing out of the Gulf into Asia. That is a fundamental trade flow which isn't going to reverse anytime soon. It's the same with the region's crude. Asia, China, India. These are the major consumers of the region's products. So that's not going to change, but it's this multipolar world that the region has become very good at navigating. And
but
I guess,
nonetheless, Andy, on the point of momentum in the current year that we're in, the US has turned a blind eye to Iran's sanction busting of oil exports, if you like. I mean, these are unilateral US sanctions to a great extent, but nonetheless, they've turned a blind eye. As a result, Iran's production is above 3 million. So the positivity of momentum needs to be in place for these barrels to continue to flow. And I'm just wondering your outlook for that momentum, this deal on the prisoners and so forth.
Well, I mean, as a long-time oil watcher, I'd say when haven't they actually turned a blind eye to some of these things?
Right.
And I think you can go all the way back to 2005. I mean, it's I think well documented. They've kept the door open, and in turning, in allowing some flexibility in the how much crude you do see flowing onto the market from Iran. that they do kind of hold out the olive branch for rapprochement going forward. They keep diplomatic ties, behind the scenes going, so that they can eventually at some point open the door to a negotiation and a settlement. That seems to be the trajectory is now that Gulf states are heading towards. You have this remarkable kind of meeting of the minds now with Saudi Arabia and Iran.
And Israel, it would appear, is also on the negotiation table. Ed Bell, just to close out with some thoughts about how high an oil price the Gulf states need or want, and where that matches up with sort of fiscal balance sheets and so forth. Above 90, they're in surplus, so they don't need to go much higher, right? 80s is everybody's happy. So the argument some make that, oh no, they want to go to 100 is not necessarily the case. Fiscal balance sheets are happy in the 80s. Your thoughts?
Yeah, certainly the levels we're at right now do imply surpluses or balanced budgets across basically every GCC economy. But hey, who doesn't want more money, right? So if you have these major kind of capital programs, particularly in Saudi Arabia, that need to be financed, you're talking potentially a trillion US dollars that needs to be financed for a lot of the scale of the CapEx projects. And that's a lot of money that needs to be generated. It's not only going to come through FDI, it's going to come through the tried and tested income generating oil exports for Saudi Arabia. So oil prices above and beyond these kind of levels will certainly be welcome and go into replenishing reserves, help to expand that capital program in Saudi Arabia, and help to, I think, really spend out more. We've seen in the UAE, for instance, a shift to more on the sort of soft skills investment or soft infrastructure investment going forward. So targeting skills development among the nationals in the country.
Let's get the survey result and last word to Mark. China slowdown is perhaps the biggest break potentially on the oil hitting 100. Mark, your thoughts on that and the outlook for China to sort of get through this difficult emergence from COVID, the outlook for obviously for LNG as a gas consumption in China as a benchmark reference to economic health, because it obviously drives power consumption, etc., and industrial development there. Your thoughts on China's recovery getting up some steam without or with a stimulus?
Yeah, I think certainly a lot of what is expected, as soon as the COVID restrictions were released at the beginning of this year, a big kind of return to activity in China. I think it's actually been more of a gradual process, certainly throughout the first half of this year. But again, if you just look at the balances there in terms of the industrialization and economy that, 1.6 billion people still growing at almost 6.5%, to me, they're going to continue to need more commodities, and in particular, more cleaner, lower emission commodities. And to me, the obvious one for that is natural gas. And then the question is where they get it from. And again, that'll be a combination of more piped imports, predominantly coming from Russia, more domestic production from the South China Sea, but also more LNG imports. And if you look at what they've done on their infrastructure side, they've started a couple of new LNG regas terminals only last month, and then there's this huge ramp up to an almost doubling in regas capacity over the next few years. So they're fully prepared for it.
Yeah, I think you can expect Chinese energy consumption to continue at a level we're currently seeing, even regardless if the macroeconomic headlines are somewhat negative, given they have at least an oil, 1 billion barrels in storage that they've purchased at relatively discounted rates relative to the current price. So I would maybe the upside we won't see in terms of more than 15, 16 million barrels a day of oil consumption, which would be a lot. But nonetheless, I think that economy can consume, as the world economy can probably consume, even in a weaker economic outlook, like we're seeing at the moment. Full employment, but yet economic weakness. These two things are coexisting. It's confusing. Andrew Critchlow, thank you so much. What is confusing that you're still bionic on a bicycle and looking great. Ed Bell, thank you so much. Mark Howson in Singapore, really appreciate your time this morning. This is our interview that's about to be posted with Sheikh Khaled Ahmed Al Sabah, from Managing Director of International Marketing at KPC. A good insight into the oil markets as seen from Kuwait. Thank you, guys. All the best.
Thank you.
Thank you.